First, head to the login page and provide your username and password. Click on Sign In. In this page, you can see the link to all different calculators. Click on the investment calculator and wait for it to load. You can use the blue button to refresh the calculations. In this page, you can see all different fields that you can provide to get the calculations. Let's start with the annual income. Put your annual income. Now provide the house purchase details. First, provide the price of the house, then the stamp duty cost, and the first year depreciation of this property. In the advanced calculator, you can use multiple years of depreciation. Then provide the regular expenses such as stratas, maintenance, and all other fees that you would pay every year. Provide the rental return of this property every month and the property vacancy, which could be 1 month per year. At this point, provide the finance details. Is it going to be an interest and principal or an interest only finance? Start with your deposit. If your deposit is going to be less than 20% of the purchase price, you're entitled to paying the LMI costs. Enter the interest rate and the finance terms, which is the number of years for this finance. Also, enter the establishment fee for this finance and the monthly fees. You can now click on the refresh button to get the final calculations. There is a refresh button in every section, also a blue refresh button at the top of the page. The calculations shows your current tax percentage as well as the performance of your investment. In this case, your tax is 21% and your after-tax income is 79%. You can utilize this 21% to cover parts of the investment costs. Hence, you will be receiving about $1,000 in your tax return. As you can see, 9% of the total income will go to the principal of the property, 71% will be the cash in your pocket, 5% will be the expenses, and 15% will be the tax that you're paying to the government. If you increase the price of the house to $500,000, your finance repayments will be increased accordingly, and you will get more tax return because of more interest that you paid for your finance. If you increase the interest rate, you can see there is an impact on your repayment as well as the difference between your principal and interest. This impacts your tax return as well because now you're paying more on the cost, which is the interest, rather than the principal of the property. If you need more insights and more detailed analysis, we strongly recommend you subscribe to our premium membership and get access to the advanced calculators.